Going to revise question 3, September 2021, Advanced Financial Reporting. The question was requiring you to demonstrate that you have knowledge on IS 12 and IFRS 2. IS 12 is accounting for income taxes. IFRS 2 is share-based payment transactions. I'll read question 3A, Roman 1. With reference to deferred tax, differentiate between permanent differences and temporary differences. First of all, what is deferred tax? Deferred tax is an accounting measure which matches the tax effects of transactions with the accounting impact. Now, just to shed more light on this, you recall that I'm sure that you've done tax and you've also done financial reporting, section 3. In tax, we rely more on Income Tax Act. In financial accounting and reporting, we rely on the conceptual framework, that is the generally accepted accounting principles, and on the financial reporting standards and accounting standards. The two standards, the two rules, that is the accounting standards and the Income Tax Act, do not converge at a given point. Instead, they repel, because you realize that in accounting, if I am to determine the net book value or carrying amount, I'll say that carrying amount is equal to cost minus accumulated depreciation. Depreciation is the making of an accountant. Actually, depreciation is a provision. It is an estimate. There is no standard that tells us that this is the amount you're supposed to provide for motor vehicle, the depreciation, building, plant and machinery, furniture and fixtures and fittings. But when you go to tax, the taxman will say that tax base is cost minus accumulated wear and tear. Why and how do you get wear and tear? Wear and tear is provided in the wear and tear schedule, which tells us how you're supposed to provide for the wear and tear of specific assets in different classes. So as a result of the treatment of transactions for accounting purposes and for tax purposes, there is that probability of an accountant either overstating or understating assets or liabilities, or the taxman understating or overstating the assets or liabilities. And in the long run, the difference on this treatment of transactions is likely to reverse in the future and giving rise to deferred tax provision. What is carrying amount? Carrying amount is what the accountant believes that an asset or liability should command in the statement of financial position. Tax base is what the taxman believes an asset or liability should command at the end of financial year. Or simply, it is the amount of assets and liabilities for tax purposes. Okay, now let us proceed. The next thing is telling you to differentiate between, I was just elaborating on what is deferred tax. And I would say that deferred tax is an accounting measure that is used to match the tax effects of transactions to their accounting impact. And I'm still repeating that financial statements preparation is based on accounting standards or generally accepted accounting principles, while the assets and liabilities of the tax base, which is the taxman's results of transactions, is based on Income Tax Act. And you have to recognize that there is no point where these two converges or agrees. In the long run, we can find that the accountant did over or understate the assets or liabilities, or the taxman over or understated the assets or liabilities, giving rise to what is called timing differences that I believe we're going to look at later. Now, what is permanent differences? They're saying that with reference to deferred tax, differentiate between permanent differences and temporary differences. Now, permanent differences occur when certain items of revenue and expenses are excluded from the computation of taxable profit and therefore could be disallowed, such as the fees. We have the not fees, we have the entertainment cost. You also have the political donations. They should be disallowed whenever we are computing taxable profit. And permanent differences never reverse, and therefore they don't result to deferred tax. No temporary differences result to deferred tax consequences because they are one-off deductions. Now, when you go to timing or temporary differences, the examiner is asking you to talk about temporary differences. We also call them timing differences. These occur when items of revenue and expenses are treated for accounting purposes and for tax purposes, but in different periods. Hence, the element of timing or temporary differences. So like what a taxman treated for revenue or expense purposes in 2017 or 2018, the accountant can do the treatment in 2019 or 2020, resulting to timing differences or temporary differences, which normally reverse in the future, resulting to deferred tax liability or deferred tax asset. Okay, number Roman 2, that was question 3, Roman 1. Question 3, Roman 2. Huruma Limited, a public limited company, has a portfolio of investments, including various subsidiaries, and also undertakes various projects varying from debt factoring to invest in property and commodities. The following information was extracted from the group financial statements relating to deferred tax provision for the year ended 31st March 2021. 1. Huruma Limited acquired a controlling interest in a subsidiary, Sukari Limited, on 1st July 2020. The fair values of the assets and liabilities acquired were considered to be equal to their carrying amounts, with the exception of freehold property, which had a fair value of 256 and a tax base of 248. The directors of Huruma Limited have no intention of selling the property. Number 2, during the year ended 31st March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary, Wingu Limited, and made a profit of 16 million on the transaction. 40% of these goods were held in inventories of Wingu Limited as at 31st March 2021. Number 3, Huruma Limited has a portfolio of financial assets comprising readily marketable government securities which are held as current assets for financial trading purposes. These investments are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss. These gains or losses are taxed when investments are sold. Currently, the investments have a market value of 412 million and accumulated unrealized gains are 64 million. Number 4, Huruma Limited's loan assets had a carrying amount of 168 million after an allowance for credit losses of 32 million based on 12 months expected credit loss. Tax relief is only available when the specific loan is written off. Number 5, Huruma Limited has unrelieved trading losses of 20 million as of 31st March 2021. These unused tax losses arose from one-off restructuring exercise carried out during the financial year, and it is highly expected that taxable profits will be available in the future. On 1st April 2020, Huruma Limited deferred tax account had a nil balance, assuming a corporation tax rate of 30%. Required, determine the deferred tax asset or liability for Huruma Group as of 31st March 2021 in conformity with IAS 12 income taxes. So this is testing again, extending the knowledge of IAS 12 with combination of financial statements or group financial statements. Before I do the question, let me just help you to understand how we identify tax base and carrying amount. I always prefer using the accounting standards, or it also requires your professional judgment also if the accounting standards that does not suffice in the decision to be made. So I did indicate that deferred tax arises as a result of the differences of treatment of transactions for tax and accounting purposes. The taxman will follow the Income Tax Act. The accountant will follow the generally accepted accounting principles and the IFRSs and ISs. For example, let's take inventory. According to IS2, inventory should be valued at the lower of NRV and the cost. That is net realizable value and the cost. IS2 is not recognized by the taxman. And therefore, if the taxman is found in this scenario, they'll take the inventory to be valued at cost. Suppose the NRV is 48 and the cost is 50. The taxman will take 50 as the value of stock, while the accountant will take 4.8 and then disclose 2,000 as loss in the income statement, loss on stock. You can see here that the accountant, because he's following IS2, is understating the stock at 48. The taxman is recognizing that the cost of the stock should be 52. Then we are disclosing, as accountants, we're disclosing 2,000 as loss in the income statement. Let's talk of debtors. When accounting for debtors, we normally consider bad debts, written off, provision for doubtful debts, and even discount allowed. Following the prudence concept that we are not supposed to overstate assets, we're going to consider all this as accountants when accounting for debtors, so that we are very certain with the amount of debt that we expect to collect. What does the taxman do? The taxman says that when accounting for debtors, he's only going to consider specific bad debts, meaning bad debts that can be traced to a specific customer. But accountant talks of bad debts, meaning general. And that means that in the event that there is no specific bad debts, then if we had debtors worth 4,000, bad debts of 200, provision of maybe 50, discount allowed of maybe 80, the accountant will report the debtors to be, that is 330, so 4,000 minus 330. In our balance sheet, we are going to report the amount for debtors as 3670. But disclose 200 bad debts, discount allowed, or this is bad debts, provision, discount allowed. We're going to disclose all this as expenses in the profit or loss. When the taxman gets the financial statements, he will say that the value for debtors was supposed to be 4,000, because to him, he only recognizes specific bad debts. And so, in this case, the accountant, according to taxman, the accountant has understated the value for debtors. This is going to result in a timing difference or temporary difference that will reverse in the future, resulting to a deductible temporary difference or taxable temporary difference, which could lead to deferred tax liability or deferred tax asset. Let's talk of payables. Payables. Payables, according to accountant, will be accounted for at the carrying amount plus any discount, not plus, minus any discount received from the payables. But the taxman will value the payables at the value which is carrying amount. So you see here, the accountant has understated the liability. The taxman is saying that that liability should be valued at the carrying amount. And so there's a lot that you need to understand here, and some of these decisions as to what is tax-based and what is carrying amount requires your professional judgment and your understanding of the general accepted accounting principles, understanding of international financial reporting standards, and international accounting standards to help you come up with what is the tax base of an asset and what is the tax base of a liability. Back to our question, Let us proceed to determine the deferred tax liability or deferred tax asset. So this is what I'll do. Let's say here details, carrying amount, tax base, timing, stroke temporary. But I need to include the column for adjustment because some of this may require adjustment. So here is details, carrying amount, adjustment, tax base, timing, stroke temporary differences. Now the first one is Huruma Limited acquired a controlling interest in a subsidiary, Sukari Limited, on 1st July 2020. The fair values of the assets and liabilities acquired were considered to be equal to their carrying amounts, with the exception of freehold property, which had a fair value of 256 million, a tax base of 248. So freehold property, shillings in millions. So we have freehold property. Freehold property. This is direct because you're given the fair value, that is the market value, 258, 256, no adjustment, 248. Adjustment here could include revaluation gain or loss, could also include unrealized profit. Okay. So the next is during the year ended 31st March, Uruma Limited sold goods at a price of 48 million to another subsidiary, Wingu Limited, and made a profit of 16 million on the transaction. 40% of these goods were held in inventory of Wingu Limited as at 31st March 2021. So we had indicated that according to accountant, we are supposed to determine the unrealized profit from this transaction and use it to reduce our inventory so that we don't overstate the stock. So the unrealized profit here is going to result to deferred tax, not deferred tax, taxable temporary difference. We have here the taxable temporary difference and the deductible temporary difference. Now, unrealized profit on inventory is going to result to deductible temporary difference because the taxman is recognizing zero value on this stock, and we have the unrealized profit on this stock that we're going to match with that tax base will result to deferred taxable deductible temporary differences. So can we determine the URP? Unrealized profit here, we are told that the selling price of this stock was 48, profit was 16. So what was margin? That is 16 over 48, giving you 1 over 3. Then 40% of the goods held in stock. That is 40% times 48. So URP is equal to 1 over 3 times 40% times 48. So what is the unrealized profit on this? It's 1 over 3 times 0.4 times 48, giving us 6.4. So inventory here, I'm going to have here 25, not 25, 6.4 negative, and here is 0. So that gives us 6.4 negative. Then Huruma Limited has a portfolio of financial assets comprising readily marketable government securities which are held as current assets for financial trading purposes. These investments are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss. These gains or loss are taxed when the investments are sold. Currently, the investments have a market value of 412 and accumulated unrealized gains are 64. So, according to an accountant, the unrealized gains are supposed to be used to increase the market value. It is like the investments have gained value. So the carrying amount for these investments is 412. We increase it with 64. So adjusted, the adjusted there is adjusted carrying amount will be, so I'll say here, adjusted carrying amount will be 412 plus 64, giving you 476. But the taxman only recognizes gains when realized. According to Income Tax Act, gains are only taxable when realized. And so, what is the tax base? The tax base is 412. Then the next is Huruma Limited loan assets at a carrying amount of 168 after an allowance for credit losses of 32 million based on 12-month expected credit loss. Tax relief is only available when the specific loan is written off. I believe it should be when the specific loss is written off. Okay, so we have here loan assets. Loan assets, carrying amount is 168 after an allowance for credit losses. It is just like determining the debtors after an allowance for bad debts. And so, according to the accountant, the loan asset is 168, having carrying amount, but the taxman will account for this loan asset at 168 plus the 32 million because you are told that tax relief is only available when the specific loss is written off. And so this credit loss is not specific, it is general. So according to taxman, the loan asset is 200. That is 168 plus 32. Then the last one, Huruma Limited has unrelieved trading losses. Unrelieved trading losses of 20 million as of 31st March 2021. These unused tax losses arose from a one-off restructuring exercise carried out during the financial year, and it is highly expected that taxable profits will be available in the future. Now, according to IS 12, we are supposed to recognize the unused tax losses as deductible temporary differences only if it is highly probable that there will be taxable profits against which the unused tax losses will be utilized. And actually, you are told that it is highly expected that taxable profits will be available in the future. So the unused tax losses, unused tax losses is going to result just going to result to deductible temporary differences, and that is not 12, 20, 20. Now this is how you end up with timing differences. We know that when carrying amount of asset is greater than tax base of asset, you get taxable temporary difference. When carrying amount of asset is less than tax base of asset, you get deductible temporary difference. When carrying amount of liability is greater than tax base of asset, you get deductible temporary difference. When carrying amount of liability is less than tax base of liability, you get taxable temporary difference. So we are going to apply this when getting our temporary differences. So 256 is the carrying amount of the asset. Okay, we have here 256, there was no adjustment. So minus 248, we're going to have minus 248, we're going to have 8 as taxable temporary difference. This is deductible temporary difference. Then 412, not 412, 476, this is what we use. This is the column we use. 476 minus 412 is giving you 64 taxable temporary difference, resulting to deferred tax liability. Then we have here 168, this is a liability. So negative 168, it is a liability, minus negative 200, that is negative 168 plus 200, you get 32, which is taxable. And if you come back here, when carrying amount of liability is less than the tax base of liability, you get taxable temporary difference. The unused tax losses is resulting to deductible temporary difference according to IS 12. So we get one figure that could be either deductible or taxable. deductible temporary differences result to deferred tax asset, while taxable temporary differences result to deferred tax liability. So we add 8 minus 6.4 plus 64 plus 32 minus 20. We get 77.6. 77.6 giving you net taxable. So our deferred tax liability is equal to 77.6 times 30%, 23.28. If you draw the deferred tax liability account, you are told that on 1st April 2020, Huruma Limited deferred tax account had a nil balance. So the balance was 0. The balance carried down is what we've calculated. So there is a net increase of 23.28 that is going to profit and loss. That is concept for IS 12. It's something that has given many students difficult time to understand, but I believe from the conversation we've had, I will shed some light on some of the aspects that gave you difficult time. Let us proceed to question 3B, which I indicated that requires you to demonstrate your understanding on IFRS 2 share-based payments. Let us go through the question together. Peponi Limited decided to grant its 500 employees 200 share options, each from 1st July 2021 on the condition that the employees still be in employment as at 30 June 2025. The company has provided the following details regarding the share option scheme. The year ended, number of employees are expected to leave employment, fair value of each option. The fair value of the option was 40 as at 1st July 2021. The exercise price of the option was 15 shillings and the par value of the company's share was 10 shillings. The average market price of the share over the 4-year period is expected to be 50. Required extracts from the financial statements of Peponi Limited for the year for each of the years ended 31st June 2023, 2024, 2025, and 2022. Now, before I proceed, what are share-based transactions? Share-based transactions, according to IFRS 2, are transactions which are based on the fair value of the shares at a given timing period. We have the equity settled share-based transactions, where the transaction is based on the fair value of the equity shares. We have cash settled share-based transactions, where the cash payable or receivable is based on the fair value of the fair value of the equity shares. And then we have transactions in which the entity receives or acquires goods or services, and the choice can be equity or cash. Now, we can now answer the question that requires you to give an extract of financial statement. Before we do that, we need to understand how to get the amount receivable if it is equity settled. Now, how do we account for equity settled share-based transactions? Once you calculated the amount, you should be debiting expense, or simply P and L, and then credit equity. For cash settled, this is equity settled. Where employees are given the options, employee options. And then cash settled share-based payments, which are normally based on share appreciation rights. How do you account for that? We debit expense and credit liability. Now, what is the formula of determining the expense? The expense is determined as follows. Number of employees, at the end of financial year times, if it is equity settled, we talk of number of options. If it is cash settled, we talk of number of share appreciation rights times fair value times cumulative time at the end of vesting period. Cumulative proportion of time the vesting period. So with this, we can be able to complete our required. So we have here employees. We have here year. Options, fair value, period. Then equity and expense. So for period 1, which is 2022, going to have 500 minus 40 times number of options is 200 times fair value, which is 40, period is 1/4. Cumulative 2023 will be, we have here remaining 460, so 460 minus 30 times 200 times 35 times 2/4. 2024, we have here 430 minus 25 times 200 times 30, 3/4. 2025, we have 405 minus 25 times 200 times 30, 4/4. So we can now calculate 500 minus 40 times 200 times 40 times 1/4. So we have 920. Let's see, 500 minus 40 times 200 times 40 times 0.25. Okay, 920. Then 460 minus 30, that is 430 times 200 times 35 times 0.5. That is 1505. So 1000. The expense that we need to account for is, because it is cumulative, we should be taking 1505 minus 920,000, because expenses accrue in the given financial year. So the expense to account for here is 585. And then here is 430 minus 25 times 200 times 30 times 0.75. That is 1,822,500, the equity to be recognized, but the expense should be 1,822,500 minus 1505,000, so that we get the expense to be accounted for in that year. And then the last one is 405 minus 25 times 200 times 30. That is 2280,000. And so because this is having the equity amount that is for the 2024 and 2025, the specific expense for 2025 will be the accumulated amount minus the previous accumulated amount of 1822,500, and that is giving you 457,500. So after that, you can now determine your expense income statement extract, financial statements extract. So we have here income statement extract. This is Peponi Limited for the year ended 30th June. Which years we have here? 2022, 2023, 2024, 25. So expense, this is 920, 585, 317, and this is 475. Then statement of financial position extract as at 2022, 23. So equity, we have 920, 1505, 1822, 500, and 2280. Yes, that is what you are required to do to earn you 8 marks. Once you understand how to utilize this formula I've given you for both options and share appreciation rights, that is for cash settle, then you simply apply and get your equity, which is accumulated, and then expenses you're supposed to account for that specific financial year by getting the preceding equity, deducting the previous equity from the preceding equity balance to get the expense for that specific financial year. That is the end of question 3. That's the end of question 3. Let's meet in question 4, 2021 September, in the next session.
Hello and welcome to the revision of the ICT paper that was examined in April 2023. Today we're going to answer question number 6. Part A reads, XYZ Limited invited an ICT consultant to set up a computer network. The consultant linked all the computers to every other in the network. The nodes were connected to every other via a dedicated link so that every node features a point-to-point connection to the opposite node. Required, state the type of network topology on the above scenario. State the type of network topology on the above scenario. Now, this type of network topology is known as the connected network or the mesh network topology. Mesh network topology, where every other node is linked to another and every node features a point-to-point connection to the opposite node. It's known as a mesh network topology. That is the answer to part A, Roman 1. Type of network topology. This type of network topology is called mesh network topology or connected, fully connected network. It is known as fully connected network or mesh network topology. It is fully connected. We read that the consultant linked all the computers to every other in the network. It is fully connected. Then Roman 2, highlight 5 benefits associated with the topology. Roman 2, benefits. Benefits associated with a fully connected topology. Now, the first benefit is that of reliability. Redundancy, I can also say redundancy and reliability. Because in a fully connected network, each node is directly connected to every other node, which provides multiple paths for data transmission. And such redundancy enhances network reliability and fault tolerance. Why? Because if one connection fails, alternative paths are available, ensuring uninterrupted communication. Reliability. That is one benefit. Because we read that each computer, all the computers are connected to each other. Each node is directly connected to other node. We read that the nodes were connected to every other via a dedicated link so that every node features a point-to-point connection to the opposite node. So there is communication both ways between each computer, and that all computers are connected. Each computer can receive information and it can give out information to each and every node in the network. And that leads to reliability. It provides multiple paths for data transmission. And if one connection fails, alternative paths are available, ensuring uninterrupted communication within the network. 2. High data transfer rate. There is a high data transfer rate in a mesh network, mesh topology. With the dedicated point-to-point connections, which is between the nodes, a fully connected network offers high data transfer rates, whereby each node has its own link, and that eliminates what we call network congestion and allows for efficient and fast data transmission. Scalability and flexibility is another benefit associated with a fully connected network topology. A fully connected network allows for easy scalability. Why? Because additional nodes can be added to the network without affecting the overall structure. It provides flexibility in the network design and also expansion, accommodating future growth and changes in network requirements. Enhanced security. Another benefit is it enhances security. In a fully connected network, each node has its own dedicated connection. It has its own dedicated connection, and such isolation enhances network security, as it is difficult for unauthorized users to intercept or access data transmitted between specific nodes. So these are 4 advantages: reliability, high data transfer rates, scalability, and flexibility. Candidates were to give 5, I've given 4. The 5th benefit could be effective communication and collaboration. Effective communication and collaboration. It leads to effective communication and collaboration because it enables direct communication between any 2 nodes in the network, and that facilitates effective collaboration and information sharing among network users. It also promotes effective teamwork and coordination within the organization. So these are 5 benefits. 5 benefits, 5 marks. This type of network is 1 mark, 1 mark. Benefits 1, 2, 3, 4, 5, 5 marks. 5 marks. Question 6B, outline 4 benefits associated with the use of pivot tables. Benefits associated with the use of pivot tables. Benefits associated with the use of pivot tables. The first benefit is data summarization. Data summarization. Pivot tables allow for easy and quick summarization of large data sets. They can consolidate and condense data, providing a concise and meaningful overview of the information, and that simplifies data analysis and reporting. Flexible data analysis. Now, pivot tables offer flexibility in data analysis, and users can rearrange and manipulate the data within the pivot table to gain different perspectives and also insights about that data. They can also easily change the row and even column arrangements. Users can apply filters, and they can also perform calculations to explore data relationships. Do you understand? 3, efficient data visualization. Efficient data visualization. Pivot tables provide efficient data visualization capabilities. They can present data in various formats, including tables, including charts, as well as graphs. And such data representation enhances data interpretation. It enhances data understanding, making it easier to identify patterns, trends, and even outliers. 4, quick data exploration. Quick data exploration. Pivot tables allow users to quickly explore and drill down data into different segments. They can then, we can also say they also provide interactive features that enables users to expand or even collapse. They can expand or even collapse data levels. They can focus on, users can focus on specific subsets of data and perform ad hoc analysis. And that saves time and effort in navigating and extracting valuable insights from complex data sets. Quick data exploration. So these are 4 benefits. 4 benefits associated with the use of pivot tables. Data summarization, flexible data analysis, there is efficient data visualization, and quick data exploration. 4 marks. 4 marks. That is part B. Part C says, evaluate 5 restoration procedures that could be used to recover lost data. Exploration procedures. Exploration procedures. That is, this is restoration. Restoration procedures. Evaluate 5 restoration procedures that could be used to recover data. That can be used to recover data. One obvious restoration procedure is backup and restore. Backup and restore. Organizations should regularly back up data and have reliable backup systems in place, which is a crucial restoration procedure. And that involves making copies of data and storing the data in separate locations so that in the event of data loss, the backup can be used to restore or to recover data. Backup and store. Backup and restore. Backup and restore. One, backup. Data replication. Data replication. Data replication involves creating and maintaining multiple copies of data across different storage devices or locations. And this procedure ensures redundancy and also provides a means to recover any lost data, and that is done by accessing the replicated copies. Data replication. Data can be copied or even created and maintained in multiple copies across different devices and locations. Data replication. Then there is point in time recovery. Point in time recovery is another procedure. Point in time recovery allows restoring data to a specific point in time before the data loss occurred, and it involves using what we call transaction logs or even snapshots to roll back the database system to the previous state, and that can effectively recover data. Point in time recovery. All right, I've said it involves using transaction logs to go back in time to recover data, or and it can be used to recover even the system to a previous state, the state where data is required to be recovered. For data mirroring. Data mirroring. Now, data mirroring is a technique where data is simultaneously written to multiple storage devices in real time, so that if data is lost from one device, it can be retrieved from the mirrored copies, ensuring data availability and minimizing downtime. Then number 5 is data recovery software. Data recovery software is another technique or a tool. Data recovery software is a tool that is designed to scan storage devices for lost or deleted data, and the software attempts to recover it. And these tools candidates employ various techniques such as file carving, such as partition recovery, or even scanning for the deleted file metadata to recover data that has been accidentally deleted. So these are 5 procedures to recover data. Number 1, data replication. Number 2, backup and restore. Number 3, point in time recovery. Number 5, data mirroring. And lastly, data recovery software. So these are 5 procedures, 5 marks. Five procedures, 5 marks. Part D reads, describe 5 features of time-sharing operating system. Features of time-sharing operating system. Features of time-sharing operating system. Features. The first feature is multitasking. 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 Time-sharing operating system can multitask.